So now we've discussed two ways in which banks can increase their loan portfolio. One is through deposits and the other way is by reducing reserves. However, both have their constraints, as we have seen. Banks are therefore faced with a difficult situation. They take deposits that are payable on demand, which are short-term liabilities, and make loans that are of longer duration, long-term assets. There is a mismatch between their assets and liabilities, and therefore there is a liquidity mismatch. So far we have discussed excess reserves as a solution to the liquidity mismatch issue. However, there are other solutions. The excess reserves are at a cost to the return on equity. The opportunity cost of excess reserves are high. So there are other solutions available to the Bank of Metrocity other than simply losing money on excess reserves, and these are called secondary reserves. So the basic issue with excess reserves is that it does not generate any yield, and hence the opportunity cost is high. In asset management, the alternative to holding reserves in cash is to hold them in highly liquid securities. Assets such as loans are highly illiquid. Banks cannot ask their customers to repay loans whenever there is a liquidity issue at the bank. Banks therefore buy and sell securities with other banks, depending on whether they have excess cash or cash deficit on an overnight basis or a term basis. We will look into this much deeper later on. This market where banks borrow and lend overnight to comply with the regulation of required reserves and manage their excess reserves is called the money market. The point to note here is that the banks use government securities to manage their liquidity now rather than parking idle funds at the central bank. So that's asset management. Liability management is simply the reverse. Banks borrow overnight funds as and when they require it. For new loans or deposit withdrawals, banks manage liquidity by borrowing overnight funds or initiating repo transactions that we will see later on. Let's now revisit the bank's profitability with this new way of dealing with excess reserves called asset liability management. Now the balance sheet would look something like this, where the deposit at the central bank is now reduced to the minimum 10% of deposits, which is $2 million, since our deposits are $20 million. The loans are $25 million, and the $3 million is now parked in securities, government securities, which are highly liquid and risk-free. The checking deposit continues at $20 million and capital at $10 million. The profitability would now be the amount in the loan portfolio into the realized yield, which is 25 into 13.25%, plus the yield on the securities. Let's assume that government securities yield 6%. So that's 3 million into 6% minus 20 million into 6%, which is your costs of deposit minus your fixed costs, which remain at $500,000. And this gives us $1.7925 million. And hence the return on equity for the bank would be at 17.925%. So before we wrap up our banking section, let's summarize what we are trying to establish here. We can see that the bank reserves are essential for banks to manage their liquidity requirements, and they are also a regulatory requirement posted by central banks. The lower the reserves, the higher the opportunity for banks to increase their asset portfolio, such as their loan portfolio, improving their profitability. Too low the reserve is a risk for banks to default on their commitments. However, excess bank reserves are expensive since they are idle funds that have an opportunity cost. The excess reserves now deployed in government securities yield a risk-free rate of interest. banks utilize asset liability management techniques to best manage excess reserves. Therefore, it is in the bank's best interest to keep reserves at an optimal level. So we will further see the importance of reserves as a tool utilized by central banks in their monetary policy implementation. Now, there are other ways by which Bank of Metrocity can improve profitability, such as lowering its equity, using leverage by borrowing, reducing its fixed costs, and many more strategies. However, our main concern here is banking reserves, so we shall not be studying the other means of improving the return on equity.